All right, welcome to the Boise Investor Group call this week. We talked about having a lender on that works with, specialty loans, renovation loans, things like that. So we have Don Walp on the call today to talk about exactly that, because I believe that to try to create equity in any real estate deal, you can either buy it low, buy it from a distressed seller, or find a distressed house and fix it and create the equity yourself. And I've really enjoyed doing that over the years. And it looks like Don has a pretty cool program for that. So let's have you start to take it away. I'm going to share my screen so she can kind of show you this slide deck.
Hi, guys. So I'm Dawn Walp. Hi, Randy. I work for a company called Prime Lending. We are actually, our headquarters are out of Dallas, Texas. And we are under the umbrella of Plains Capital Bank, which what that means for us is that we have the ability to do a loan that will later be sold to Fannie Mae. So we meet Fannie Mae guidelines, but we have the opportunity to tap into some equity, whether we're purchasing or refinancing and doing a renovation. So I'm going to first just start with, I guess if you want to go to the second screen, Kevin, that'd be awesome, or the second slide. Perfect. So we're going to talk about purchasing a home and renovating it, or just doing a renovation refinance. So as investors, when you purchase the home and want to renovate it, there is a requirement to have equity of at least 20%, as is with all purchases when you're financing an investment property. So how this works, how we're tapping into future equity, if you will, is with what we do is we ask you, you're making the offer, ask for, which I believe you guys do anyway, a little bit longer due diligence time or inspection contingency time, so you can get some contractors in there to see if they can get you a bid based on the what you're wanting to do to the property. So if it's new flooring, if it's new cabinets in the kitchen, or removing a wall, or whatever it is, what you'll do during that due diligence is you'll get those bids from those contractors. And then all you have to do is present those bids to me. I send those bids to the appraiser, so the appraiser can appraise the property after the renovation is complete. So we're tapping into that equity before the work is actually done.
So say so Don, say you buy a house around here, or say you buy an investment property for 100 grand and it needs 25,000 in reno, but then it becomes worth like 150. And so is the appraiser able to see the repairs and do like an as is and then an after repair value, like saying if this work was done, the home would be worth this much? So they're kind of giving it two looks.
So yes and no, in the sense that in reporting, for instance, we will get an appraisal that is subject to these items being complete.
So you're going to just get the after repair value.
Yes. Okay. And so what's nice about this transaction is, so if you're working with a realtor or you are a realtor, you just negotiate the purchase price of the house as you would, as the house stands today. And then on our loan piece, we will do, with your plans and specs and your cost to build or cost to renovate, we will send those to the appraiser. The appraiser will appraise the project as if it is complete. So we are able to loan more than, we're able to loan based on that appraisal value and not the purchase price. So seriously, it can be done, the transaction can be done in 30 to 45 days. We side on the 45 days out of the gate, just because, when we're working with contractors and stuff, it might take them a little longer to get us documentation than in a normal purchase. But once we have the appraisal back and we've done all the credit piece, the underwriter has approved it, the loan is actually going to close. The seller is going to get their funds. The realtor is going to get paid. and the new buyer, or you guys, the investors, you'll get your keys. And the renovation starts at, once you are the owner of the new property. And depending on the program, and we'll kind of get into it a little bit, but depending on the program, that will determine how many contractors you can have. And then based on their bid, they can get up to 25%, anywhere between 15 and 25% of their cost to renovate upfront at closing. So they'll have a little bit of money to get going. And exactly the same is true on the renovation, on a refinance picture. If you have a property that, maybe it's had some renters in it for quite some time, they're moving on, and you need to do some work to it, we would do the very same thing. We would send the appraiser out with the costs for the renovation that you're wanting to do.
And then you would do like a refi with a renovation built into it.
Yes.
Okay.
Yeah. So if you'd like to go to the next slide.
Can I ask one question, Don?
Oh,
And that is,
please.
it sounds to me like you're going to be in first position. Is that correct?
Yes.
Okay.
Yep. And so one of the things that's really nice about how we're able to structure this is when we're in the construction phase, we're actually, in a sense, we have the loan in our portfolio while we're going through construction. And then once everything is complete and we have our certificate of occupancy, then that's a good point. I'll get back to that. Anyway, so we'll do the certificate of occupancy, and then the loan is sold to Fannie or Freddie in the sense that it's converted to a traditional mortgage. And that does happen behind the scenes. The only difference is that actually there really isn't any difference. It's gonna roll right to Fannie and Freddie. I will say that we do have a contingency, so we require, depending on the equity, anywhere between 5 and 10% of the cost to build. So obviously, if the cost to build is $100,000, then we need $1,000. Now that $1,000 can either be financed into the loan, or it can be brought in at cash at closing. And so once all the work is done, we're gonna shake out the balance sheet and everything and see, how all the funds worked. Did we use all of the funds? Did we not? And whatever is left will actually go to reduce the principal. In regards to that contingency, if you finance it into the loan, then that amount is going to go to lower the loan amount. If you actually brought that money in at closing, then that you would actually get that money back.
And you said it's 10% of the renovation, approximately. So if you do $100,000 reno, it's going to be 10 grand.
Oh, sorry. Yes. 10 grand, not $1,000. Yes.
Yeah. Okay.
Yes. Yeah. So
Dawn,
these are just, yes.
Dawn, I have a quick question. So then when the renovation's done, is there another appraisal done?
Yes, the appraiser will go and do a re-inspection to make sure that the items that he listed, because he'll list our initial appraisal as subject to, and list the items that needed to be repaired or improved or whatever. And then they'll go back out and they'll assure that those items have been complete.
So just so you know, everybody else on the call knows I'm an appraiser. The question that I have is, ultimately my question is, what happens if it doesn't appraise? What if the market shifts on you in the 4 months you're doing a renovation, or the 3 months? What happens then? And so when the appraiser goes out, it doesn't reappraise at all the numbers that make this thing float.
So that's a really good question. What would happen is the investor would need to make up the difference. Because what happens is sometimes, although that's why we're going to the appraiser initially, but I understand what you're saying, because one of the things we'll say is that you're not going to always get penny for penny what you put in as to how much the value is going to increase. And so that's really what we're looking for the appraiser to tell us in the beginning. But yes, the owner of the property would have to bring in the money, and if not, then.
Do you know in your, so everybody, if you look at the bottom of page 1 of an appraisal,
Okay.
there is where she said it's subject to that first appraisal, there's a box there. It's either, oh golly, I do it all the time. I think it says as is.
Yes.
By doing an appraisal, normally the appraiser checks a box that says as is. The next box to check, if they don't check that one, in this case would be subject to. One of the big issues for the appraisal profession is that Dawn, do you have any idea if the same appraiser goes out? Because the same appraiser may view it differently than the next guy that may come and look at it in 3 or 4 months. Do you know if the same appraiser goes out and does it? Because that
So that is what our intent is to have the same appraiser go out. And our third party system that has to reach out to them will reach out to that direct appraiser. Now, if that appraiser declines, we'd have to go to somebody else, but.
Right. That just a FYI, everybody, that can be a little sticky wicket there because there may be two appraisers aren't going to appraise this thing in the same way. Anyway, I don't mean to make this an appraisal question. I just was curious.
No, but
going to work.
I appreciate that. So, and that is a really good question. When we do talk, for instance, maybe someone, just an example that I feel is pretty, clear is that if you put a pool in, and the pool costs $30,000, that pool is not going to increase your value by $30,000. And so if that's the case, then obviously funds will need to be brought in order to make up that difference. And so that would be the same as if the project didn't appraise. So I've had 2 situations. So I've done this personally. I've used this program personally. So I know how it works, and it was a great program for us. We were hopeful that we would get more value when our project was complete, and we didn't. It just came in at exactly the same. But so that is something to think about. So this is just a marketing piece, really. But one of the things I want to point out to you, as I think someone asked through the chat, is that Prime Lending is a national company, so we can do loans all across the country. So this program is, available all across the country. And, I've used it here with many clients, but we have people and, that have used it all across the country in different markets. So, okay, so let's go to the next slide, Kevin. Obviously, this is just a slide that's going to talk to you about what we can do. If there are required repairs, those are things, that absolutely will fit into the renovation program. And then optional, any kind of renovations that you want to do. And, I do caution my clients just about the penny for penny, analogy, in the sense of you need to be realistic about it and make sure that what you're putting into the home or using the renovation loan for, you'll get the funds out of it that you're looking for. Okay, so let's go to the next slide. So this talks about different programs, and this is just a very high level. We have very many programs to help facilitate this loan. The one that's used most commonly is the EZC conventional loan. So all of these are conventional loan programs. We do have the FHA 203K, although that's only for a primary residence. So that doesn't fit into, our bubble right here. But it depends on the dollar amount that you're going to be spending, which will determine the program that we're going to select for you. And we'll obviously, that's the piece that I know, and we'll put you in the best program that will allow you to do the items that you want to do. Okay, so Kevin, let's go to the next one. So this is really the process, and it's really a typical purchase. So we're gonna complete the application, and the application is really about your credit and your income. So I look at it as there are really 2 pieces, maybe even 3, but 2 pieces to this loan. There's the credit side, so that the credit and the income side. So that's your piece. And I would encourage you that if you think that this is a program that we're going to use, that you want to use, then allow me to review your application, your income and your credit before you're ready to write your offer, in a sense. Just because if you have any complicated income tax returns or anything, it gives us an opportunity to delve in and see how we can make it work for whatever whatever property you're going to choose. And so that piece, and if I need to send the file to underwriting ahead of time before you have a property, we can absolutely do that. So that's the credit piece. And then the next piece is the bids and repairs. So this is where you're going to the contractor and you're asking them to evaluate the home, inspect the home, and see what you're able to do and how much those things are going to cost. And then with those bids, we send those bids to the appraiser, as I mentioned, and the appraiser will appraise the project as if the items are complete. And understanding that, and that even at that time, they're going to tell us if we think we're going to get the value that we were looking for. The next piece is we go to closing. And well, so I'll back up a little bit. After we get the appraisal, just in the how the whole process works is we'll go back to underwriting. The underwriter will appraise. The underwriter has already evaluated the income and the credit. So now we're bringing in the appraisal, which is the property. And if we don't, have any requirements or anything, then the file will go to our closing department and we'll work with the title company to balance our numbers. A closing disclosure will be sent out. And when a closing disclosure is sent out, we have to wait 3 business days before we can actually sign loan documents. And then once we close and the new buyer has the keys, the renovation can begin. And what happens is we have so in the renovation loan, there is a $900 fee that is in addition to your typical closing costs. That's the fee you're going to pay for this type of program. And that is to ensure the draw requests are done correctly, and we'll do inspections on the property to make sure that when those draw requests are submitted, the project has progressed through those steps. And then, we'll work with the contractor, whether it's a general or you have a couple different contractors that are doing, different work. Maybe you have flooring, maybe you have plumbing. And then we'll, work through the whole process. And then as soon as the process is complete, then we'll send the appraiser back out there so that they can reappraise the property or re-inspect it. And then everything's good to go. Do you guys have any questions about that process?
Yeah, Don, this is Dale. Yeah, I do have a question. I'm a private lender, and many of the rehabbers that I work with don't show any W-2 income. But that's okay because I'm an equity lender. Does your credit worthiness depend on a W-2 income?
No, so we can use 1099. We can use self-employment income as long as it's reported on the tax returns. We'll analyze the tax returns, and whatever income we can pull from there, whatever income is reported to the IRS is what we can use. Okay, so we'll use rental income. Yeah, we'll use rental income if they have rental income, if they have Social Security or money from an investment or whatever their income stream is. That's what we're going to look to.
Okay, thanks.
Yeah.
Does anybody else have any questions about this process?
I do have a question about the rate.
Okay.
Are you in a position to talk about rates, or are we getting ahead of ourselves here?
No, you're fine. We can absolutely talk about rates. So the rate is going to be a little higher because it is considered a construction loan in the sense, which it has a additional layer of risk. But right now we're at 3.5. But I will tell you, when we personally did it, we started in October of 19. Yeah, we started in October of 19 and our interest rate was 4.5. But at that time, we were comfortable with the process, and that 4.5 was, was okay. But now we've come down, obviously, because the market's come down. So it is a fixed interest rate. So you'll be locked, and that will be it'll be a 30-year loan. So if you want to refinance, if the rates are lower, then we can certainly refinance to lower your rate. Otherwise, that rate that we lock your loan with will be the rate that the loan proceeds with.
Is there a prepayment penalty?
So no, there is not. One of the things we do ask, though, because the pricing is very competitive, is we ask you to keep this on the books for at least 6 months. Because if you sell the property before 6 months, then we will take a hit. And so I want to be upfront and honest with you and ask you upfront, hey, we really want to make sure that we can keep this loan on the books for at least 6 months.
So it may not be a real good program, and I don't want to be negative here, but it may not be a
No.
real good program for a rehabber who plans on flipping the property within a couple months. Is that a fair assessment?
Yep, that's a very fair assessment. And so this is a really unique, and it's a great program, although it does, it's more geared for the consumer in a sense. That's going to renovate their property and stay in the home.
Or like an investor that wants to keep it as a rental, maybe too.
Yep, absolutely. Yes. And if you have a rental and it's dilapidated and you want to renovate it so that you can hopefully gain some higher rent, then that's an option for you too. So yeah, it's certainly not going to replace the, if you will, hard money loans, because those are short term. This one is at least a minimum of 6 months.
And Dawn, it's like, just to clarify, so if you were doing, as an example, like a flip product where you're buying something that's a large lot and you're going to section off parts of that lot, you folks are able, per my understanding, to into that and say, hey, we're going to appraise and assess and provide loan value based on what sits on it right now. But do you have the capacity within that loan product to say, hey, we're also going to develop out like 3 or 4 other units here. Can you guys lend on that kind of a development that would obviously take well over 6 months?
So that's going to be interesting, because if I understand what your goal is, you're going to want, well, let me ask you, I guess, are you going to want, so we're doing 4, let's say we're doing 4 lots. Are you want 4 different loans, or are you wanting 1 loan?
We can't, like in a perfect world, it would be 1 loan, but it would be based on the appraised value of what that 4 developed lots total would look like. So you've got 1 house on it and you're going to build 3 more. And so you've got 1 piece of property that you can say, hey, here's my spec of the house that's on it. Here's the repair estimate. And then here's a building estimate for the balance of what I want to build out on that lot. Can you folks originate that loan with that kind of prospectus on it and loan against that as a single loan?
Unfortunately, no, because Fannie Mae won't allow multiple structures on one property. And so we're bound by Fannie and Freddie. And so that's what, I mean, it's a cool program, but we definitely have parameters that we have to stay within.
Thank you.
Yeah.
I moved to LA for the weather.
One more question. You talked about a fee of $900. Are there points in addition to the fee?
No, so there isn't. It's going to depend on, so now that you say that, I'm going to look, because obviously with COVID, we changed some things. There may be a 1% origination fee, or it's called a discount point. We do it as a discount point so that if you itemize your taxes, you can, and have the ability to write that off, then you'll be able to do that. If we do it as an origination fee, you aren't able to write that off. So I'm going to dig into the discount point and see if it's on there or not. So at Prime Lending, we typically don't have an origination fee. We use that to allow our borrower to buy the rate down should they choose. But in the renovation, I'm having a brain cramp. I can't remember it, because since we don't typically charge one, I'm not sure that there is one. So I'll look that up and then send a message to Kevin and give you guys an update on that.
And hey, Don, one more question too. We saw some blip about Fannie, Freddie limiting the amount of investment properties they will loan on. Do you know
Yes.
about what the story is with that, or is that more clear now?
So right now it's 10. You can have 10 mortgage loans, and they have not changed that for some time now. So that's mortgage loans in general, whether it's an investment property or whether it's your primary or a second home.
Okay, and it's still 10.
Yes.
Okay. I heard something that they were limiting down to 2, but maybe they're just changing their fee structure or something.
It could be, because we are still at 10.
Okay. Cool.
Awesome. Any other questions? I know that, this is just something to put in your back pocket. As I said, because I am bound by Fannie and Freddie, but this could be a good program for you guys.
Hey, Dawn, put your contact information in the chat too, so people can find
Okay.
you if they need to. Does anyone have any other questions about like this particular loan program? Or I think it's interesting that, she can do this across the country, which is kind of cool.
It's Don. It's like the question that I have is always, what is your minimum loan value and what's your maximum loan to value? Because of course, where you're buying in places like the Midwest and your average house value is $50,000 or $60,000, that can become a real challenge originating a loan.
Yes, and we don't have a minimum loan amount because of the all the properties across the country are all different values. And just like I'm typing this in here. And I would say maybe 50,000 would be, so what's going to happen is it's just going to be a really expensive loan. It's just 50,000 because the fees are, they're
$5,000,
They're-
no matter how much you borrow, right?
right. And so that's the hard piece about it, is that if it's a $50,000 loan, we'll be happy to do a $50,000 loan, although the fees stay the same, like they don't go down, because it costs us the same amount to facilitate that loan as it does a $400,000 loan.
Sure. And that's why I asked, because I know
now-
I know there are some
No, no,
Fannie
no.
and Freddie based rules around the fee structure percentage versus the loan total amount. So I wanted to make sure there weren't any limitations, because to me, it's like, I'm one of those people who's like, I would be willing to pay $3,000 to $5,000 to originate a $50,000 mortgage, because long-term scale of what it costs me, it's a drop in the bucket. So I
Right.
just want to make sure, like, I know a lot of folks cannot originate just because that fee structure as a percentage of the loan is in excess of what they're allowed to give.
Right. So I'll dig into that a little bit deeper too, and get back to Kevin, because I've done loans across the United States, but not those small loans. So I'll look and see where that runs into a problem, because you're absolutely right. There is a threshold, and we don't want to have a high fee loan for a small loan amount. So I'll look into that.
Thank you.
The other thing is that the other thing I'll tell you is that because of COVID, some of our programs have been suspended, and they're still suspended. So we are not able to do any jumbo loans. And what that means is any loan amount above $548,250. So if we can keep our loan amounts below the $548,250, then those are conventional loans, and we can do those all day long. But as soon as we go over that, we don't have a program because it's suspended.
This is awesome.
And because it's a Fannie Freddie, you can do correct single family, duplex, fourplex.
Yes,
Yeah, I do.
yes.
Cool.
So yeah, and I'm available at any time if you guys have any questions, if you want to run a scenario by me or anything like that. I'm going to get back to Kevin on the discount point, and then also on the loan amount.
Okay, and
So
I'll just send,
probably not till it.
I'll send an email back to everybody.
Okay, perfect.
Well, cool. Does anyone have any more questions for Don? I don't want to keep her
Awesome.
forever, but appreciate you taking some time to share this knowledge with us, and some of the people in the call really have enjoyed working with you. So
Thank you, Dawn.
Yeah, you're welcome. Thanks you guys for the opportunity. And again, I'm available for any questions, scenarios, whatever.
okay, cool.
Awesome. Thanks for the invite, you guys. Have a great day.
Thanks, Don.
Yep.
So that program works awesome until you get to 10. And if you're dumb like me and you put your wife on all 10 mortgages, then you're stuck at 10. So I've spent probably 16 to 20 hours trying to find a lender that will get me past 10. And I think I found a couple options. In Indy, there's a lender I talked to yesterday called Stockyards Bank and Trust. And trust, Brandy, that part, you taught me that little trick. They can do a portfolio. They can do a commercial loan with a 15-year AM with a 5-year balloon. Minimum loan amount $5,000. So they don't have a minimum loan amount. Yeah.
Yeah.
So, she's going to send me more information, but it stays in your LLC. It's a commercial loan. The rate right now is 4, 3.5, 4 still in commercial. So I'm like, okay, I'll take 20 of those, please. So but it's a 15-year AM. So with a 5-year balloon. So, cause it's kind of commercial. So I don't know how that's going to look for cash flow, but
What was that again, Kevin?
Stockyards Bank and Trust. Once I get the information, if you guys, I'll share it with you guys. But and then I found a portfolio lender. Most of these big portfolio lenders want like $500,000 minimum, or properties that are over $100,000, or all these stuff, right? I found a guy. Let me see if I can tell you. So I took your advice and I went to Bigger Pockets and I clicked on like hard money lenders in Illinois. And then I said, I want more information from like 15 of them. And I found a guy, FBC Funding, Louis Jeffries, this guy's name. And they can do these little portfolio loans. I think the minimum loan is like $150,000 or something. So once I get more information and see if that's actually legit. And I don't know, Brandy. It sounds like that Stockyards is local to like that. There's a couple branches, but they're like in that little region right there, So, but I mean, almost all of them were like, we don't take out of state investors, minimum loan amount, $100,000, like da 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 da. But I did find a couple that can still do it. So.
And I also got a lead, Kevin, from the multifamily meetup that I totally forgot about last week, which is Harris Bank, which is in Midwestern. Like they're originally, I think they're out of Chicago actually, but they do some commercial type lending. And so we actually have a local person here who I'm going to go meet with and powwow with about what we're doing there, just see what kind of commercial portfolio type product they might be willing to, or able to originate, just because they are from that part of the country. He said they absolutely lend in and around the Indianapolis, Cincinnati, Cleveland, like that whole.
Yeah, Chicago's not very far.
Bucket.
Chicago's not very far from there. So
exactly.
Okay. Well, everybody, yeah, keep searching, because the
The other lender from that meetup too, Kevin, was Mountain America that are doing portfolio loans.
here or anywhere.
The guy was buying in the Midwest and in Idaho. So he had mentioned that he had a portfolio loan through Mountain America, and it has multifamily and some commercial aspects in it. So that might be an option too.
I've used Mountain America. They had this Maku 90, which was a 10% down investor loan, and you could have like 2 of those. And then they had a Maku 85, which was a 15% down loan, and you could do as many of those as you wanted. And all that stuff shut down at COVID. And I don't know what happened to them, but it is a nightmare. Their underwriter system is just glitched. And every time I recommend them, I regret it because the lending process is terrible. Their loan product is great. And I have some of them, but man, is it a bear to get through the underwriting process. So for what that's worth, and then I have a lot of their loans. And so I was going to do my cash out, my line of credit on my house with them. 4 weeks of back and forth, no answer. Idaho Central Credit Union, 12 hours, offered me 50 grand more, closed in a week. Boom. So for what that's worth, they get an F in my book right now for being able to perform.
Yeah, that sounds like proof in the pudding that your small local credit union and or bank and trust is probably the guy to have in your back pocket.
Man, I know Central, man. Anytime I ask them for anything, they give it to me immediately. It's awesome. If I have a problem, they fix it immediately. And their online app is awesome. I can move money from one of my banks to another, like one of my accounts to another one, like in 2 seconds. It's awesome. So
Kevin, are you going to quit claiming your wife off of all the properties, or you're going to quit claim yourself off of them to her?
No, we're just going to go the commercial route. We'll find a way. The little portfolio loan, it's $5,000 to renovate to do these little loans. So it's like on a $50,000 loan, that's a lot. I don't want to mess with those. And they're all at 4.25. I just leave them like that forever. So we'll find another way and put them in the LLC or something. But I think if this other guy, this RBC funding or whatever the heck it is, if they can do like a little chunk of like 4 houses at once, that would be nice. I'll just do that like 3 or 4 times. So, but I think he did have a 6-month seasoning requirement. So this is a fun little trick. Say Elizabeth, you buy a house for 25 and put 25 in it, and it's worth 60 when you're done. You got 50 in it, it's worth 60 when you're done. These lenders, a lot of them can't refi, they can do a cash out refi of only like 75% of what you paid for the 25 grand, which is useless until 6 months. But if you have a friend that you trust, that'll give you $50,000 straight out of the gate and puts a mortgage on the house for 50 grand on day one. So I loan you 50 grand, hard money loan, whatever, and it's recorded on the house on day one. You fix it, and then in 3 months when it's done and rented, you do a cash out refi. The points are cheaper because it's a rate and term refi. It's easier, it's cheaper, and they don't have to wait 6 months. So I've seen people do it with like one of their LLCs to another one of their LLCs, and that seems a little shady. But if it was like a non-relative doing it, that's totally legit.
So yeah, that's not quite arm's length, like one LLC or even from you personally to your LLC. That's not quite arm's length enough to not get in trouble. But we actually, it's funny you mentioned this because this is actually how we do some of our private money lending, is that we will do a flat term loan to somebody so that they can avoid the seasoning period in the flip. So we've got one out right now. We didn't even put down, I think we put down $50,000. It's a $400 and something thousand purchase price. And it was an owner carry. So the way he financed it is that the owner's carrying the balance of the 370 or whatever it is all in. We gave him the 50, which is the rehab cost of it essentially. And as soon as it's stabilized and he has renters in it next month, then he can go in and start the cash out refi immediately. So he'll be in it maybe 65 days, and they're gonna have to underwrite for probably 20 or 30 just because he's a longstanding client there. But we did a flat fee to him. So for our $50,000, regardless of when he gets the refi done, he pays us back the 10 within a 1-year period. So I'm making $10,000 on top of the 50K I gave him within a 3-4 month period, which is crazy. Like this is bad interest rates. Like this is usury stuff. This is a flat lending fee loan. And that's why, so he could avoid the season period, because you do have to have either the cash in the bank that has to season for a minimum of 60 to 90 days, or you have to have seasoned the property for stabilization for a minimum of 6 months. And right now, with a lot of the refis as investor properties, they're actually requiring a year. We just found out.
Okay.
Yeah, you can do rate return refi, so much easier.
Yeah, I don't know why in their system, it's just easier for them to do that. And if you're not asking for cash out, then the rate is better.
Yep.
So
It's so funny. Yeah, I'll buy another person's note, whether it be performing or not, before I'll write you a new note. It's just kind of silly.
So a little housekeeping. The next 2 weeks, I'm going to be traveling, and so I'm not going to be able to run the meeting. And I want to see if anyone would be willing to run the meeting. I'll give you the login and password to Zoom, and you can start it up and run it. Because I'm going to go and figure these houses out and go buy another half a dozen of them. So, and when I'm out doing stuff like that, I just totally forget about everything. So. Even if I promised you I'd be on the call, I probably would be lying. So, would anybody be willing to run the meeting for a couple weeks?
If you want to email me this stuff, Kevin, before I commit, let me make sure that my next 2 weeks I'm in town as well. It's like, let me double check.
Okay.
Yeah, if you just want to email it to me, I can turn on the meeting at least
okay.
those 2 days.
Okay, cool. And then I'll have fun stuff to report back to you guys, because I think that I was talking to my business partner, and here's an interesting, so when you're starting to accumulate properties like this, one of the big hurdles is cash, because you're kind of sucking up cash as you're kind of buying these things. And so if I can find a couple owner carries, that would be awesome. Even if I have to pay full rate, I don't care. What is it going to be? 50 grand? Who cares? So I'm going to look for some of those. And then all this free money the government is printing right now. That
Your tax, no, it's not free money, Kevin. It's the taxes your children and your great grandchildren will still be paying.
I know, but irregardless, like there's these EIDL grants for businesses and things. And, we didn't apply for one, or we did just because I was doing all that stuff. And then we realized we don't really need that money. But that is a whole bunch of money at 3.25% for 30 years. That's not attached to me personally, with no personal signature.
Yep.
Okay.
The cash reserve is cash reserve is the bottom line.
Yeah. So I think that I'm looking into that option of, like, if I can get 100 grand or whatever the government will give me, that gets me to accumulate. I think it'll push me over the edge to get the other dozen properties I need. And then I just have to work through refinancing them and buying them, fixing them, and getting them rented and refinancing them. And I think I'll probably be done at that point. So that's
the other option. I don't know if have you looked at, so one of the things that we have looked at recently is the SBA loan. So Small Business Administration makes all kinds of loans, and they are still writing a lot of loans right now, in fact. And the real estate sector is kind of that thing that through COVID held up the economy and has kept the US stabilized more than any other industry.
Yeah.
And as such, if you are a real estate professional who has a decent business plan and even a minute's worth of a track record, you can go apply through whomever. It can be Idaho Central. It can be whomever can originate an SBA loan for you right now for cash. SBA loan doesn't matter. You have to designate a plan that says, hey, this is my operational capital for the next year, or this is my payroll capital for the next 3 months. You just have to designate, like, here are the buckets I'm going to use it in. And if you end up not using it in that bucket, once that loan is originated to you, you can use a small business loan for any expense your business has, including as a cash fund to buy property. And while SBA loans only have like I think the longest term is like a 7-year term. In 7 years, you're going to have every single thing refied back. So who cares?
Yeah. See, these are all the creative things that you guys, we all figure these out, and because like that's like the little roadblock right now. It's like if you're trying to accumulate more, it's sucking up all my cash, and so I'm like, okay, I'm stuck, and I'm finding a way around it. So. Thank you guys for helping me. One thing that Bob and I had talked about in the past was creating a little turnkey product for people. And I think Elizabeth, you may have mentioned it too, in this Muncie market. If there's anybody that, maybe we should talk about that again and say, what if, you I buy a property, or Elizabeth, you buy a property and fix it up and put a tenant in place, and then, mark it up 10 grand and sell it to, cost plus 10 grand to somebody in the group. If they want, a turnkey rental property, then they don't want to deal with the work or have the contractors or any of that stuff.
And that's one option. It's like we had talked about it several months ago, and my husband finally convinced me that we're actually doing some of that. So of the huge groups of properties that I'm looking at right now, I'm doing a pre-screen on a bunch of things just to make sure that they fall within certain criteria for parts of town, types of tenants, stabilization of neighborhoods, things like that. I don't go into places where there's shootouts every week or there's bars on the windows, because that's a little too much of a D- to F market for me right now.
Yeah.
Will it gentrify and transition? Maybe, but today's not its day until you built the infrastructure around it and kind of weeded that population out. But in full disclosure, like, I'm providing a turnkey property to Levi at the end of next week. Like,
Good
he is
job.
full on buying a property that we went and saw when we were happened to be in Indiana. He liked the house, and he's like, I want to get something sooner than later. Let me buy this one from you. So that's exactly what I did. Is, hey, here's my cost, and it's I think I marked up. I think it's about $10,000 or $11,000 just to cover all the cost in it. But he's still going to buy the house for $40,000 because I buy incredibly inexpensive houses in that market, and we build new homes into them. So we make sure that we keep that price kind of at a capped rate. It won't most likely qualify for a mortgage unless you use the microloan product, but there will be some of those things in that between 40 to 55 price range, I would imagine, that we will have done before the end of summer.
Okay. I'm going to try to keep, it seems like even with this portfolio loan, these little mini portfolio loans, they're okay having a couple of 60s in there, but they want a couple like 70s or 80s in there too. So I might have to find like maybe some over by the college or something that are a little bit more expensive that I can bundle together. So that seems to
And
be.
yeah, the real key is that, like, it is a market that is expanding, and we're at the very beginning of it. The very beginning of it was about 3 years ago, but we're in the still slow growth stage of the market. So the thing that you're going to buy today that you're going to pay $50,000 or so for, like, I have an agent specifically and exclusively there and a broker that we work with, and of the portfolio that we have, I was trying to find my little spreadsheet because I have a big spreadsheet of all this stuff. He has gone and done a just quick pass over everything that we have because they are in need of housing pretty desperately. They're both for rental and for end buyer right now. And so we were going through the things that we already own there that are not currently occupied, or that the rents or the tenants contract is coming due, to see what, if any of them, might make an acceptable flip property to the market instead. And we were pleasantly surprised with what the actual rates are, because we had, I think, underestimated what going rate would be in that market by between $10,000 and $15,000. So when I say that I'm selling Levi a property for the mid 40s, its actual value right now is sitting right at about 60 or 61. And it's just because I have the space in that, like, I don't need to gouge Levi to make a good deal. Let's leave some skin in it, and let's leave some percentage of equity in it so that you have the option to finance it at some point in the future, or even right now when you buy it. Because to scrape out everything I can doesn't help anybody.
Well, I think we might have to change the name of this group to like cash flow investor out of state something or other, because we don't ever talk about anything in Boise here anymore. So I don't know. It's all right.
Like, we're still doing projects in Boise, so
Yeah,
when Chris
I
finishes
do have a
buying
nice,
everything, like, I want to buy some more things this month.
I have a nice flip we're doing here. It's almost done. So, but
Again, we're starting one here in a couple of weeks. I know that Brandy, I think, has some stuff cooking on her boilerplate. So yeah, I think there's still lots of options here locally. It's just a matter of the right connection and asking the right people.
yeah.
This market's dead. There's nothing left. Just forget about it.
Liar.
Yeah, Chris.
Abundance mindset, Christopher. You can't have it all.
Yeah.
Fair.
He disagrees that he can't buy everything.
And that was one of my limiting beliefs from the past, that I thought that there was no deals here. They're here. You just have to look for them, just like anywhere. It's harder to find them right now, but they're still here. So I work. In my olden days, I'm an REO agent from Boise. I've sold almost 1,000 bank-owned properties here, and we still keep those relationships active. And we got an email from the servicer that services all VA loans in the country, and they have a 10-year contract with the VA. So they're gonna, and they know what's coming. And the email a couple days ago said, make sure all your licenses are up to date. Like make sure you've done our trainings, make sure your E&O is right and your insurances are good. And like they're sending out like a few other little like questionnaires about vacant property registrations and stuff that we don't have to do here. But so they're anticipating, they're like, the email basically said, you know, get ready. So, you know, what does that mean? I don't know what they see stuff that we don't, but they probably see how many VA foreclosures are on the books or coming or in default or something. Cause that email was like,
Well, I just learned,
something's
Kevin,
coming.
just as a share point to that. So I just learned because I happen to know a local asset manager, and I forget, she's with, not City, one of the big ones. She's an asset manager in this area, and she happened to reach out to me the other day just to say, hey, it's not that they are not foreclosing on things right now, but people are still turning their houses into the bank
No way.
to get the heck out of the problem, and they're just not releasing them to the market right now. They're very slowly trickling. So there happens to be one right now on Mountain View. If you popped up in your MLS feed, it's $0. They're auctioning it off in a couple of weeks. It might be next week or think, but that's exactly what it is. It's a bank-owned asset that the owner passed away. Family didn't want to deal with inheriting and taking care of mortgage debts and things. They turned it back over to the bank. They literally handed the house back to the bank in one of the hottest markets in the country. It's a bank-owned, it's not on the MLS listing, but it's a bank-owned property.
Yeah, it happens still. There's always that.
Until the auction.
Yeah. And I put my offer in almost a month ago. They told me no, they want a minimum of 530, just so everybody knows.
Now, I put in my second offer at 557 and they still denied that. And they said there's not taking at this point, they're going to auction.
Yeah. It's like, yeah.
Kevin, my question was, when you get that list, is it only for Idaho? Like, do you just get that list for Idaho, your VA?
Oh, that was from the asset manager as a general email to all the realtors that are in their system. So I don't get a list from that per se, but and so it kind of, every bank, every servicer, every hedge fund, everybody that owns these mortgages disposes of them in a different way. So if you had two side-by-side houses with Chase that were serviced by Chase Bank, right on Rimview or whatever the heck the name of the road is, they're probably owned by two different, it could be the Teachers Hedge Fund of Kansas. And then the other one is owned by the Firefighters Union in Kentucky. And they have different rules on how they dispose of their assets. The Teachers Union may say, we want to fix stuff so that we can, get a better value. And the other one may say, we just want to dump it as fast as possible because we're not in the business of keeping houses. So even though you look at it and you're like, oh, that's a Chase asset, they do it this way, it's not true. And so it's very confusing. But there's a couple things that are the same. Like any VA foreclosure forecloses the same way. And so Chase, if it was a VA loan, they're going to give it back to the VA. And the VA is going to dispose of it how they do it. And I mean, I could talk about this for days because it's my world. But just to say that there may be some stuff coming, but here, I think I think most people have equity, and I think it'll get listed with a regular realtor and sold before it goes to REO, unless there's the 0.5% that gets inherited and don't know what to do with it, or they die and there's no heirs, or there's going to always be a little bit of default where they put their head in the sand the whole way through the process and they just give up. So there's always going to be that. But
and Kevin, I guess from your perspective, because this is kind of that's your field that you play in. From a HUD perspective, because HUD I found does exactly the same thing. Like when HUD forecloses and takes back possession of a house, the housing and urban development group, like they get rid of an asset in a very specific way. Like here, first passes this, second passes this, here's your credit available to it, things like that. Given the volume of HUD houses in the Treasure Valley, do you suspect that we will see significant comeback through HUD, or are they all separately now managed under other assets almost entirely?
Well, I've sold like 500 or 600 HUD houses. So it was my biggest account back in the day. And sometimes we're getting 2, 3 a day. And so we had 85 of them at one time. It was madness. But so every bank, so say you do an FHA loan through Chase. So Chase, it's going to, and it gets, and you go into default. The way that the HUD works right now is there's something called, so HUD doesn't want these properties back, right? They don't want them back. And so they created this program it's called CWCOT, and it stands for Convey Without Transfer of Title. There's some kind of thing like that, where they basically say, we're going to send these things to auction before we actually take title to them, and we're going to allow Chase Bank to sell them before they actually convey it to us, and we're going to allow that. And it's a special program, and it went on all these auction sites. So if we're going to look for these HUD homes, we're going to look for them on auction.com, on Williams & Williams, on things like that first, because as they get foreclosed on, but what's going to happen is they're going to go in, they're never even going to get to that point, because they're going to get in the newspaper as a notice of default, and somebody's going to go knock on their door and pay off the loan. Now, when it gets to where there's no more money for the flippers to buy direct like that, they'll get foreclosed on, and they'll push to these auction sites, and they'll sell there at a predetermined discount by the state, per state, on those auction sites. And if they don't sell there after like 3 rounds, they're going to convey to HUD, and then HUD's going to start the process from scratch, and they're going to run it down their normal routine. So it's wicked complicated, but that's kind of like the path of it. But here, I'm telling you, the minute they hit the newspaper, somebody's going to go knock on their door and write those guys a check, pay off that loan. But if it doesn't happen, it will eventually go to foreclosure. And if the flippers don't buy it at foreclosure, it'll end up, as long as it's a big bank, it'll end up on one of the auction sites for a while. And if that doesn't happen, then eventually it'll convey to HUD, and it'll become a HUD home. And then it goes down its normal HUD process, but that takes a while. So if you ever want a learning lesson on on all those foreclosure stuff, I have a bunch of that stuff in my brain.
That'd be a really good one when you get back from Indianapolis to go over before the market does weird things again.
Well, and that's the thing, like, we're not going to see it here, but I bet you $50 we're going to see it in Muncie.
That's what I'm wondering. Is the process the same? How can I, like in the markets that we're looking at that aren't as hot as this,
Yeah.
how can we get a hold of those? Like, I want the list from Mobile, Alabama. I want the list from Chester.
You need to look on auction.com is the biggest. So once they get foreclosed on, if they are a HUD home, they're going to go on auction.com. They're not going to hit the MLS.
How can I get that before that? Like you were saying, like here, obviously people are going to go pay cash. Why can't we do the same thing in these other markets?
Well, you can. You have to get the newspaper there and look at the notice of defaults. And every state forecloses differently. It's really confusing. So you have to learn on how does whatever state you were just told me about, how do they foreclose on a property? Like Florida, forget it. It takes 2 years to foreclose on a house there. But here, it's fairly quick, and there's a process, and it's pretty efficient, and it flushes through quickly. You can buy a house in Florida, never pay a mortgage for payment for 2 years, and live there for free, probably more.
And it doesn't pay in 30 days. They're out in 2.
Yeah. So I would say, if you want to see if they're coming, start reading the newspaper or looking at the notice of defaults and learn that state how they foreclose, and then hunt those people down that way. Because that's kind of like the first real tell that is kind of to public knowledge, right? Is that first notice of default, like publicly notifying, hey, you're in default. And so other than that, I mean, what are you gonna have to do? Advertise to them or something? But that is like the first public notice. So. So. All right, well, let's cut it here. I'm gonna go buy some houses. So.
I'll call you later, Kevin. I did get your message. I'm just behind.
Yeah, call me because I want to make sure that you can log into this Zoom thing because I don't know, you may text me or some random thing or something. So,
Okay.
okay, cool. Thanks, guys.
Thanks all.